welcome to our market segment, where our top story today focuses on a dramatic shift in cryptocurrency investment patterns. Ethereum-based exchange-traded funds have attracted an impressive $393 million in investments this month, marking a notable transition from Bitcoin-focused investments. This surge represents a seven-fold increase compared to January's figures, with consistent inflows recorded on all but 2 trading days. The trend becomes even more striking when contrasted with Bitcoin ETFs, which have experienced a $376 million outflow during the same period, managing to attract new investments on only 4 trading days. This movement appears to be driven by sophisticated trading strategies, including carry trading, where investors simultaneously purchase spot ETFs while taking short positions in Ethereum futures. Despite this substantial institutional interest, Ethereum's price has remained relatively stable, hovering between $2,600 and $2,800 since early February. However, market experts are optimistic about Ethereum's prospects, particularly with the approaching Pectra upgrade scheduled for April 8th. This technical enhancement promises to optimize Ethereum's infrastructure, potentially improving transaction speeds and staking mechanisms. In a groundbreaking development for European crypto markets, trading platform eToro has become one of the first major companies to secure a MiCA license from Cyprus regulators. This milestone achievement enables eToro to offer cryptocurrency trading and custody services across all 30 countries in the European Economic Area. The license, granted under the European Union's Markets in Crypto Assets regulation, marks a significant step in the standardization of crypto services across Europe. The approval from the Cyprus Securities Exchange Commission not only covers the 27 EU member states, but also extends to Iceland, Liechtenstein, and Norway. MiCA, which came into full effect in December, represents Europe's comprehensive approach to crypto regulation, requiring service providers to obtain a CASP Crypto Asset Service Provider license to operate legally within the region. This framework aims to create a unified and secure environment for crypto trading and custody services. In a significant development in the FTX saga, a federal court has confirmed the final tally of Sam Bankman-Fried's forfeited assets, totaling approximately $1 billion. The detailed court document, released by the U.S. District Court for the Southern District of New York, reveals an extensive portfolio of holdings previously owned by the convicted former CEO. The largest single item in the forfeiture was $606 million in Robinhood shares held by Bankman-Fried's company, Emergent Fidelity Technologies. Additional significant assets included substantial cryptocurrency holdings at various institutions, with Alameda Research holding $56 million in XRP and millions more in various other digital currencies at Binance. The forfeiture also encompassed substantial financial holdings across multiple institutions, including $119 million in Tether at Binance, $50 million at Moonstone Bank, and $101 million at Silvergate. 2 private aircraft, a 2009 Bombardier Global 5000 and a 2006 Embraer Legacy, were also seized. The court document detailed over 250 recovered political donations that had been distributed to various campaigns and organizations. Coinciding with this development, FTX began its first round of bankruptcy payouts, distributing $1.2 billion to smaller account holders who will receive approximately 119% of their initial holdings from the 2022 collapse. In a significant shift for the cryptocurrency industry, Bitpanda CEO Eric Demuth has highlighted how the Trump administration's pro-crypto stance is reshaping global digital asset adoption. Speaking at Consensus Hong Kong, Demuth emphasized that the current market momentum differs markedly from previous cycles, driven by institutional capital rather than retail speculation. The CEO of the Vienna-based exchange, which serves over 6 million users, pointed out that the US government's embrace of cryptocurrencies is creating a domino effect worldwide. The Trump administration is forcing everybody to do this. It's not an option anymore, Demuth explained, suggesting that global markets must now adapt to this new reality. This transformation is evident in the success of Bitcoin ETFs, which have accumulated nearly $58 billion in assets within their first year. According to Demuth, this represents a more mature market phase, where major investors are making long-term commitments rather than seeking quick profits. Looking ahead, Demuth anticipates US banks will lead the next wave of adoption, predicting an increase in bank-issued stablecoins and tokenized traditional assets. His company, Bitpanda, is already partnering with major financial institutions like Deutsche Bank, providing crypto infrastructure through back-to-back services, while maintaining its focus on European expansion. This evolution marks a crucial transition from cryptocurrency's speculative past to its integration into mainstream financial systems, backed by institutional commitment and regulatory frameworks. In a significant policy shift, the US government is preparing to establish a national Bitcoin reserve, according to a new analysis from financial firm Bernstein. This initiative could prompt other nations to begin acquiring Bitcoin as a strategic asset. The report outlines several funding possibilities, including the Federal Reserve potentially issuing new debt or selling portions of its gold reserves. The government could also incorporate approximately $20 billion in previously seized Bitcoin into this national reserve. Key structural questions remain about implementation, particularly whether the Federal Reserve or Treasury would oversee the purchases. Bernstein's analysts note that Federal Reserve involvement would require legislative approval. This development aligns with the Trump administration's recent announcement of a sovereign wealth fund targeting investments in leading US crypto companies. According to Bernstein, these initiatives signal continued market growth for both Bitcoin and related equities. The move indicates a notable shift in government approach to digital assets, potentially reshaping how nations manage their strategic reserves in the digital age. The European Central Bank is taking steps to modernize its financial infrastructure by developing a system to settle distributed ledger technology transactions using traditional currency. The initiative will follow a two-stage implementation process. The first phase will connect to the ECB's existing target settlement system, which currently handles Europe's cash, securities, and collateral flows. Following this, the bank will develop a more comprehensive long-term solution for settling DLT-based transactions with fiat money, including foreign exchange settlements. This is an important contribution to enhancing European financial market efficiency through innovation, said Executive Board member Piero Cipollone, who oversees the initiative. The ECB has been exploring digital currency technology since 2023, building on collaborative work with financial market stakeholders to investigate how wholesale financial transactions on DLT platforms can be settled using central bank money. The bank will announce a detailed timeline for these developments at a later date. In a significant shift within the investment landscape, traditional financial institutions have demonstrated unprecedented interest in Bitcoin through regulated exchange-traded funds. Recent SEC filings reveal institutional investors allocated an impressive $38.7 billion to spot Bitcoin ETFs during the fourth quarter of 2024, marking a threefold increase from the previous quarter's $12.4 billion. Leading the charge, BlackRock's iShares Bitcoin Trust has attracted over 1,100 institutional holders, setting what analysts believe could be a record for first-year ETF adoption. For context, most new ETFs typically attract fewer than 10 institutional holders in their first year. Notable participants include the state of Wisconsin's Investment Board, which now holds over 6 million shares of BlackRock's Bitcoin Trust. Legendary investor Paul Tudor Jones's fund nearly doubled its position to over 8 million shares, while Corvex Management established a significant position exceeding 1 million shares. This surge in institutional adoption comes through regulated investment vehicles, requiring quarterly disclosure from investors managing over $100 million in assets. The trend represents a maturing market where traditional financial institutions are increasingly comfortable gaining Bitcoin exposure through familiar, regulated investment products.
In a concerning development for the cryptocurrency industry, sophisticated scammers have allegedly used artificial intelligence to defraud companies of more than $5 million in FTX bankruptcy claims. Analytics firm Inca Digital has uncovered evidence of fraudsters using deepfake technology during video calls to impersonate legitimate claim holders. The scam involves criminals presenting themselves as holders of valid FTX liquidation claims, complete with authentic-looking documentation and verifiable claim data. The perpetrators reportedly conducted video calls with potential buyers, using AI technology to alter their appearance and establish credibility. After successful transactions, the stolen funds were quickly moved through international cryptocurrency exchanges. At least 2 companies have fallen victim to this scheme, with losses totaling $5.6 million. The fraudsters leveraged a combination of sophisticated techniques, including face-swapping technology, forged identification documents, and access to genuine bankruptcy claim information, which may have been obtained through data breaches. This incident is particularly relevant as cryptocurrency markets continue to evolve and mature. For investors and traders, it serves as a crucial reminder about the importance of thorough verification processes and the emerging risks posed by advanced technologies in financial transactions. As the crypto industry grows, particularly under the current administration's policies, the need for vigilance against increasingly sophisticated scams becomes even more critical.
And now moving on to our blockchain technology lessons, here we have part 3, blockchain architecture. At its core, blockchain is a revolutionary way of storing and validating information. To truly grasp its potential, we need to understand its fundamental architecture, the building blocks that make this technology so robust and transformative. Let's start with the most basic unit, the block. In essence, a block is a container for data, but it's not just any container, it's a highly structured, cryptographically sealed package of information. Each block typically contains a set of transactions, a timestamp, and a unique identifier called a hash. This hash is not just a random string of characters, it's a cryptographic fingerprint of the block's contents, created using the hash functions we discussed earlier. But a single block doesn't make a blockchain. The magic happens when we chain these blocks together. Each block doesn't just contain its own hash, it also contains the hash of the previous block. This creates an unbreakable link between blocks, forming a chain that stretches all the way back to the very first block, known as the Genesis block. This chaining mechanism is what gives blockchain its famous immutability. If someone tries to alter the data in a block, it would change that block's hash. This, in turn, would invalidate all subsequent blocks in the chain, as their link to the altered block would no longer be correct. To successfully tamper with the blockchain, an attacker would need to recalculate all the subsequent blocks faster than new blocks are being added, a task that becomes exponentially more difficult as the chain grows longer. Now, let's zoom out and look at the network. A blockchain doesn't exist on a single computer. It's distributed across a network of nodes. Each node maintains a copy of the entire blockchain. When a new block is created, it's broadcast to the entire network. Nodes then validate this new block and add it to their copy of the chain. This distributed nature is key to blockchain's resilience. There's no central point of failure, no single server that can be hacked or shut down to disrupt the entire system. As long as even one node survives, the blockchain survives. But this distributed system raises a crucial question. How do all these nodes agree on what the correct version of the blockchain is? This is where consensus mechanisms come into play. These are protocols that ensure all nodes in the network agree on the state of the blockchain. The most famous consensus mechanism is proof of work, used by Bitcoin. In this system, nodes, or miners, compete to solve complex mathematical puzzles. The first to solve the puzzle gets to add the next block to the chain. This process is incredibly energy-intensive but highly secure. Other blockchains use different consensus mechanisms. Ethereum, for instance, is transitioning to proof of stake, where the right to add a new block is determined by how much cryptocurrency a node holds and is willing to stake as collateral. Transactions are the lifeblood of any blockchain. When a user initiates a transaction, it's broadcast to the network and collected into a pool of unconfirmed transactions. Miners then select transactions from this pool, verify them, and include them in a new block. Once a block is added to the chain, the transactions within it are considered confirmed. This architecture, blocks linked in a chain, distributed across a network of nodes, with transactions verified and added through a consensus mechanism, is what gives blockchain its unique properties. It's decentralized, transparent, and incredibly difficult to tamper with. As we delve deeper into blockchain technology, you'll see how this basic architecture can be adapted and expanded to support a wide range of applications, from simple currency transfers to complex smart contracts and decentralized applications. The architecture we've discussed here is just the foundation, a robust, secure base upon which a new digital world is being built.